I'm feeling a little bit green today. The whole household is sick, so I'm going to add a little bit of color to this lesson on the Cashbook payments. You might know it as the Cash Payments Journal. And as we go along, look out for Caleb's bouncing balls as he's throwing them around the house. I hope you enjoy this lesson and you are smiling. And on the sandy sea shore were these shells littered with the accounting bookkeeping cycle. You thought you were going to spend some time on the beach, but what you paid for was the Cash Payments Journal. So I'm going to go through the Cash Payments Journal with you in detail on the sandy shore. In front of you, you have the accounting cycle, the bookkeeping cycle. I will show you this document all the time, or quite often, so you understand what we're doing in the lesson and how it fits into the context of the bookkeeping cycle. So today we're going to look at cash transactions. We're going to look at cash purchases. We're going to have a look how they documented these cash transactions, and then we're going to take that information and we're going to put it into the Cashbook payments, and from the Cash Payments Journal we're going to post that information to the general ledger. So there is an example of a cash tax invoice. I will show you the documents like I did with the Cashbook receipts. I will go through each document, but this document here, you would get an invoice and then you would make a payment. Just here some transactions. This first transaction is an example of what type of transaction goes into the Cashbook payments, but we at Calibre Education have a loan and 2,000 Rand is being paid back on the loan. We purchased a computer, paid cash from the computer store. We made an electronic payment to the computer store, an EFT, an electronic funds transfer, paid for petrol for the delivery vehicle, purchased a kettle, paid by check. So those are examples of transactions which will result in a decrease in our bank balance, and the appropriate journal for these type of transactions is the Cashbook payments, the Cash Payments Journal. So all these transactions, there's another one, issued a check to pay wages. They all need to be documented. When we make a payment, we normally get a slip from the shop where we've purchased items, and then we make a payment. We can get a receipt as well so this is supporting documentation, the invoice, the slip, a receipt, and on these documents it says what did we buy, it tells you what we bought. Then what we're going to do, in most of the text they're still using checks, so we write out a check and this part here gets torn off, and the part that remains behind is called the check counterfoil or check stub, and all the details of the payment will appear on the check counterfoil, and the check counterfoil is used to record the transaction, the payment, in the Cashbook payments. Now EFTs are being made today, a lot more common. I don't think checks are used that often. And the document that gets used when we make an EFT is the payment confirmation slip. Right, there's confirmation of the payment. And attached to that EFT confirmation slip would be the supporting documentation, what was purchased, etc. Now, from the documents, the information is posted to the Cashbook payments, and I'm going to go through in this lesson the Cashbook payments. And then what we're going to do is we're going to take that information and we're going to post it to the ledger accounts, the general ledger accounts. So that's what we're going to do over the next hour or so. I hope you enjoyed this lesson, and like I always say, you're going to become an expert at drawing up the Cashbook payments after this lesson. I forgot to mention that transactions can be written up from the statement we receive from our bank. And for example, here's service fees, which are bank charges, and that will make our bank balance smaller. Anything that makes our bank balance smaller in our books needs to be recorded in the Cashbook payments. Here you can see this was service fees, so this transaction here needs to be recorded in the Cashbook payments, and the document we use is the bank statement which we receive from the bank that we bank with. So here's another document that we can use to write up transactions in the Cashbook payments. Remember, we're doing the books of Calibu Education, and these are all the transactions that took place for the month of February. Now we're specifically looking at those transactions that affect the Cashbook payments. So once again, I have highlighted all those transactions with a green block. That CBP stands for Cashbook payments. Remember, that can also be called the Cash Payments Journal. So any transaction that makes our bank balance smaller needs to be recorded in the Cashbook payments. And this one here, I'll quickly summarize it. But basically, we're making a payment, an installment payment, to pay back the loan that we have from the bank. We also, in the month of February, purchased a computer, paid by check. A check is cash, so we paid cash for this computer. Another transaction we will look at. Then it looks like we made an electronic payment, an EFT, to the computer store to settle the amount of money that we owe to them. So we're going to have to check on the 17th all the transactions relating to the computer store to see how much we're paying to the computer store. And there's another one, quite an easy one, right at the bottom of the page. It says on the 18th we paid for petrol for the delivery vehicle. Now I've put that in there specifically because there's no VAT on petrol, but we'll check that out when we do the journal. Remember these little pictures here? They're just logos of the people, the stakeholders of Calibu Education. We have the bank, those people that have an interest in Calibu Education. We got the computer store, and we got a client, the school. Those are the role players in most of my exercises. So let's move on those were the transactions up until the 18th. So we just passed halfway through the month. We need to see what other transactions need to go into the Cashbook payments. All these red blocks indicate other journals that in this series we will complete. Oh, and one of Caleb's bouncing balls. I did tell him not to throw the balls in the house, but he seems to be continuing. Just adding a little bit of color here and some fun before we move on to the next slide. These are the transactions that took place from the 18th to the 27th. They are role players, and let's see which transactions need to be recorded in the Cashbook payments. So here we have a kettle that was purchased from Kloppers and we paid by check, so we're going to have to deal with that transaction. There's a smart screen that was bought from the computer store, paid a 2,000 Rand deposit. That's going to be interesting. We have an account with the computer store. The smart screen cost 10,520, but we only paid 2,000 at this stage. The rest was bought on credit. We will deal with that transaction. That's why you see there we've got Cashbook payments. An amount will go into the Cashbook payments and an amount will go into the creditor's journal. Paid wages, remember wages paid on a weekly basis. Issued another check to the computer store for the amount owing on account. So once again we're going to have to calculate what do we owe to the computer store up until the 25th. Remember, we've already made a payment to them, but we pay them again on the 25th. We're going to have to calculate that amount. Then we get a bank statement and there's a debit order. We need to record that debit order just to make sure that we reconcile with the bank statement. We will eventually do a bank reconciliation statement. Actually, let me repeat that. We will do a bank reconciliation at a later stage. And what is left here? Some more transactions on the 28th. Let's see which ones go into the Cashbook payments. On the 28th, there is a check that was drawn to restore the petty cash Imprest amount. I will go through with you what that actually means. The petty cash Imprest amount. Paid the rates and taxes. There's a whole lot of money being paid to your local municipality. There's a debit order on the bank statement and their bank charges also on the bank statement. So you have 4 more transactions that need to go into the Cashbook payments. So there are quite a few transactions I'm going to work through with you. And remember, you're going to become experts of the Cashbook payments. You've already seen most probably the Cashbook receipts video I made, and then there will be lots of other journals, but we're going to focus here on making you an expert on the Cashbook payments or cash payments journal. And we're going to have a little bit of fun along the way, although it's going to get quite serious after this slide. So let's do it. I'm going to go through the documents involved in drawing up the Cashbook payments. What happens is, the computer shop sold to Calibu Education, it's a cash invoice. That means Calibu Education has to pay for the computer on delivery. If you buy it online, you might have bought it before you receive it, but it's a payment that's been made. Now this document is supporting documentation for Calibu Education. Calibu Education is going to pay for the laptop by either a check or EFT. So this document here, a cash tax invoice, is supporting documentation. You get the invoice and you make a payment. The words tax invoice clearly shown with cash. It's a cash tax invoice. There the settlement terms, cash on delivery. I took off all those little information bullets, let's call it, just to show you what the document actually looks like. Well, the ball looks confused, but it's not that confusing. We get the document and we make the payment because it says COD. And if we make a cash payment, what happens to our bank balance? It decreases. Anything that affects our bank balance negatively will go into the Cashbook payments. Oh, lovely picture. Unfortunately, it's a little bit blurred. I hope you do find time just to relax a little bit. Another document which is supporting documentation is a slip. So we get a cash slip from a shop and we make a payment either by check or an EFT. You could use a debit card or a credit card, right, to make the payment. Whoop, plop. Another document is a receipt. We make a payment, and stationery was bought, so we got a receipt as proof of payment. It's supporting documentation for the payment that Calibu Education is going to make. Wow, we're not running out of bouncing balls. Now this is the document that is going to be used to record a transaction in the Cashbook payments. In front of us we have a check, which is an instruction from the drawer to the drawee to pay the payee a sum of money. That there I can see is an error. The date is in the wrong place. But who was being paid? The stockist for stock, and the amount is 7,300. What happens is this check is issued. You pay the payee. The drawer here is Mama Marushka. She has signing power. The drawer is actually Calibu Education. To the drawee, which is the bank, to pay the payee, which is the stockist. It's quite a mouthful. All we're doing here is Calibu Education is paying the stockist by check. And this piece here is left behind in the checkbook. The other side of the check, which I'm shading in, not crossing out, just to indicate that part of the check is issued to the stockist, and the stockist will deposit that at the bank in order to obtain the money. And here I've gone and divided the check and the check counterfoil. And at Calibre Education, we use the check counterfoil or the check stub to record the payment in the Cashbook payments. And there we go. The stockist, or whoever got paid, will take this check to the bank. You happy? I hope so. Here's some accounting in the clouds. All accounting, or a lot of accounting these days, is saved in the clouds. In front of you, you have the Cashbook receipts. The Cashbook receipts I did in my last video, and you can see there are similar column headings as we compare the Cashbook receipts with what we're doing at the moment. So in the Cashbook payments, we have columns for document, day. Now we have name of payee. The person or place whom we are paying will appear under the name of payee, like the petrol station, the computer store, Kloppers, we're paying them. Then there's a column here for folio, in case the payee has a folio. When we pay a creditor, for example, we will do a transaction like that. We can go check in the creditor's ledger, and we're able to pick up the reference C1 for the computer store, which stands for creditor number 1 in the creditor's ledger. Then we have a column for bank. Now remember, in the Cashbook payments, in our books, Calibre Education, we are looking at the bank account, the credit side. So when the bank balance decreases, this entry is going to go on the credit side of bank in our books, because it is a decrease in assets. If we're in overdraft, it's actually an increase in liabilities, but more about that later. Then there are columns after bank, because the one account will always be bank with all these transactions, because they're cash transactions. We have a column for creditors control, accounts payable, because we're going to pay a creditor. Once again, when does an item have its own column? If a transaction happens on a regular basis, it will have its own column. There's a column most of the time, if VAT is involved, for input VAT, which is VAT we can claim. Debtors control, we will have a look at that if there's a transaction relating to a debtor. Trading inventory, we purchase stock. Then if a transaction doesn't happen on a regular basis, there's a column for sundry, and under sundry you're going to have transactions, for example, a repayment of the loan, an installment on the loan, the purchase of fuel, a staff expense, purchasing the odd equipment. Wages could have warranted its own column, as wages are paid on a weekly basis. So those are the column headings. The Cashbook payments is definitely, for me, easier than the Cashbook receipts, as the Cashbook payments didn't have that analysis of receipts column or a cost of sales column. In the Cashbook payments, we're looking at transactions where we're paying cash, by check or EFT, electronic payment for items. We're paying cash for items. So they're the column headings for Cashbook payments. Let's see if we can get on with some transactions. We're ready to look at the transactions which go into the Cashbook payments. So let's have a look at the first transaction on the 3rd. It says here, interest on the loan amounted to 1,500. The first installment on the loan was also paid, and the first installment is 2,000. So what we're going to be doing is we're going to be paying back the loan, and every month a payment is made. And what they're saying here in the transaction is 2,000 Rand was paid for the month of February. This interest on the loan is going to be recorded in the general journal when I do the general journal. So we're doing the Cashbook payments. So let's have a look at recording this 2,000 installment. So we picked up this information from the bank statement. So the document is the bank statement. The day was the 3rd. Who is being paid? The bank with whom we took out the loan. What came out of our bank account? 2,000. And what was it for? Under sundry, because this only happens once a month, this installment is paid once a month, there's 2,000. And under details, the name of the contra account. Loan, we have a loan with the bank. So there we go. That's recording an installment paid. This installment was paid on the 3rd of February. There's no VAT involved on a loan in this case here. Right, next transaction. On the 6th, we paid by check for stock purchased from the computer store, 19,000. So we paid by check, so it is a cash transaction. We're making a payment. It goes into the cash payments journal. There's a negative movement on our bank account with this transaction. Our bank balance has got smaller. So we write out a check. What we're left with, the check stub or check counterfoil. And the date was the 6th. Who did we pay? The computer store. Just there would be a check number here. Let's just make it for the exercise check number 1. The amount that was paid under the bank column, 19,000. Now we are going to use the stock. Obviously we're selling the stock that we've purchased, so it's a standard rated item, which means we can claim input VAT on the stock that we purchased. And the calculation, remember all the numbers include VAT unless otherwise stated. So the stock we purchased was 19,000. So that included VAT. If I want to calculate the input VAT which we can claim, remember I have a whole lot of VAT videos. If you don't understand VAT that well, you can go check them out. So 19,000 multiplied by the VAT fraction is going to give us 2478 and 26. So the trading inventory amount, which excludes VAT at the historical cost price is 19,000 minus 2478 and 26 cents, and that is equal to 16,521 and 74. Another quick way to calculate the amount excluding VAT, you can say the VAT inclusive amount of 19,000 divide by 1,15, and that will give you the amount that we paid for trading inventory excluding VAT. Trading inventory has its own column because the purchase of stock should happen on a regular basis. Remember, if something happens every now and then, it appears under sundry. So they're the first two transactions for the month of February that were recorded in the Cashbook payments or cash payments journal. Let's have a look what's happening here on the 17th. As said, there it is, made an electronic payment to the computer store to settle the amount owed to them. Remember, the computer store, we have an account with them and we buy from them on credit. So we're looking at accounts payable, and we're going to pay the computer store on the 17th what we owe to them. They give us a 5% settlement discount. Now I'll tell you straight away, the settlement discount, how we dealing with it, is it's going to go through the general journal. I'm looking at the Cashbook payments here. So we want to establish what is getting paid to the computer store. Sometimes in certain text or textbooks, you will have a column here up top here for discount received, but we're going to deal with the discount in the general journal at a later stage. So the difficult thing here is actually finding out what is owed to the computer store on the 17th. Now this is a little bit small, but it's not a problem. What I've done is I've gone in taken a screenshot of all the transactions that relate to the computer store. Now what would happen in reality on a daily basis, all those transactions would be transferred to the creditor's ledger, and the account would be obviously the computer store. So if we went through this account, we would go to the 17th and we would see what amount is owed, and that there says 63,050. If you're not given the creditor's ledger, you would have to take out all these transactions in your workings and just scribble them down somewhere on your paper, all the transactions that relate to the computer store, and you keep a running balance so you can establish on the 17th what is owed to the computer store. So I've consulted this ledger, the creditor's ledger, and on the 17th Calibu Education owed 63,050 to the computer store. The computer store gave Calibu 5% settlement discount because maybe this amount of money was settled in good time. And in order to take off the 5%, you can punch into your calculator 63,050 minus 5%, or you could say 63,050 multiplied by 95%, and you would get the following answer. Just going to rub this out. That would give you 59,897.50. And who was paid? The computer store appears under name of payee. This was done by EFT on the 17th. And creditors control, under the creditors control column, it has its own column. The amount that was paid is 59,897.50. The settlement discount, like I say, of 5% will be recorded in the general journal. And just what I mentioned earlier, sometimes some textbooks will put this through the Cashbook payments. It doesn't really matter, because at the end of the day, the correct accounts will be debited and credited. But in this exercise, I'm going to do the settlement discount in the general journal. So yeah, if you make a payment to a creditor, you need to go and find the balance owing to the creditor, either in the creditor's ledger. If you're not supplied with that information, you're going to have to go and search for all the transactions that relate to the creditor and keep a running total, so you know how much is going to be paid with the transaction. I hope that makes sense, and we're ready to move on to the next transaction. A nice easy transaction on the 18th. It says here, paid for petrol for the delivery vehicle, 1,200. There's the document, the check counterfoil, the date is the 18th. Who did we pay? The petrol station. What came out of our bank account? 1,200 when the check is deposited. And under sundry, there's 1,200, as fuel didn't have its own column. Now with fuel, sometimes the examiner is going to try and trick you, especially when it comes to VAT. So you need to know where you can claim input VAT, standard rated items, and when you cannot claim VAT. And fuel is a 0 rated item, so you cannot claim VAT. That is why there is no VAT calculation in this transaction. So there we go, very easy. 1,200 under bank, 1,200 under sundry, 1,200, and what was it for? Fuel. Also on the 18th, another transaction took place, and once again, this is a little test of how well you know where you can claim and where you can't for VAT. So purchased a kettle for the staff kitchen from Kloppers, paid by check 345. Anything for the staff is a non-allowable item, which means the VAT is 0. VAT cannot be claimed for staff functions, staff items, right? So the VAT will be 0. So let's do it. Check counterfoil 345. Who did we pay? Kloppers. What was the amount? 345. And under sundry, because staff expenses doesn't have its own column, the amount is 345, and nothing under VAT. So there we go. Let me just say this while I'm thinking about it. In the details column for sundry, you write the name of the contra account to bank. Remember, we're in a cash book, so the one account will always be bank. And in the cash book payments, bank will be credited because it's a decrease in assets or an increase in liability, depending on the situation of our bank account. And these accounts here will be debited. But the reason why they're debited, I will explain when I post this information to the general ledger. I'll go through the rules again. Right, so on the 18th we purchased the kettle for the staff. Very easy. Under bank is the amount 345. Under sundry is 345, and which account is going to be debited? Staff expenses. It's an increase in expense, and the rule says debit, but more about the rules a little bit later. Next transaction, on the 23rd, it says here we bought a smart screen from the computer store. And let's see how we're going to deal with this. For presentations, the price was $10,520 including VAT. Now we paid a $2,000 deposit, and the balance is going to go on account. So all we need to record here is the amount that has caused the movement in our bank balance. At this point, we have only spent $2,000, the $2,000 deposit. And what book are we in? The cash book payments. So we are looking at all those transactions that result in a smaller bank balance. So the 2,000 will result in a smaller bank balance. So it goes into the cash book payments. So we paid by check this deposit. The date was the 23rd. Who did we pay? The computer store. What was the amount under bank? Only the amount of the deposit, which is 2,000. And when we bought this smart screen from the computer store, we are using it in the operations of our business, so we can claim input VAT. And in order to calculate the input VAT amount, we say 2,000 times by the VAT fraction, 15/115, gives us 260.87. And in order to calculate the exclusive amount, all we need to do is we need to say 2,000 minus that VAT amount you just calculated, and it is equal to 1,739.13. And this smart screen that we bought will be put under equipment, the equipment account, because we're using this equipment in our business operations of teaching accounting. So there we go, paid a deposit on the 23rd. Next transaction, nice and easy. Issued a check to pay wages, 5,000. There's the check, the date. Under name of payee, when you write out a check to a person who's paid on a weekly basis, it might be a cash check. So in this case here, on the check you write pay cash. So under name of payee we write cash. The amount is 5,000 under the bank column, and there's no VAT here on a wage. Maybe pay as you earn, some other tax, but no VAT. And under sundry you have 5,000, and under details the name of the contra account to bank, which is wages. So there on the 25th issued a check to pay wages, 5,000. On the 25th, they say this transaction took place, issued a check to pay the computer store, the amount owing on our account with them. Now once again, like we did previously, when we paid the computer store, we need to go and check what the amount is. And the easiest way is to check the account of the computer store. On the 25th, the amount owing is 12,170. If they don't give you this account, which keeps a running balance of what we owe the computer store, we need to go and take all the transactions like we did earlier from the transactions given and calculate what is owed to the computer store, because they don't give you the amount in the transaction. You will have to calculate it. So we go and find out 12,170 is owed to the computer store, was paid by check on the 25th. What came out of our bank account, or what is going to come out of our bank account, 12,170, and the ledger account, creditors control, is debited, decrease in liability, and the amount is 12,170. More about the rules when I post to the general ledger shortly. Now this account here, while I'm on it, is a general ledger account, and the creditors control account is a summary of all the individual accounts in the creditors ledger. It's a control account. So if I wanted to know what I owe all my creditors, I go in the general ledger to the control account and I see what the balance is. In the creditors ledger, we will have all the individual accounts, the computer store and whoever else we buy from on credit. I just thought I'd throw that in there. But what we did here in the Cashbook payments is we've gone and put the amount under bank and put the amount under creditors control. On the 27th, wait for it, Shopify. There was a Shopify debit order. If you're watching these videos, you would have got this most probably off my website. In order to have that platform, it's done on Shopify, and I pay a monthly amount. This is just an approximation for the exercise, but the Shopify debit order of 550 came off the account of Calibu Education, the bank account. We need to record it in our books. So under name of payee, we got Shopify. The amount was 550. I need this platform in order to operate. So it's a standard rated item. I can claim input VAT, and what we say is 550. I've blocked out the calculation, but let me just show it to you quickly. 550 was the VAT inclusive amount times by the VAT fraction is equal to 71 Rand 74. And 550 minus 71.74 is equal to 47826. And I opened an account in the general ledger and I named it online rent for the rent I pay to distribute these videos. So there you go. That's what happened on the 27th. On the 28th, we drew a check. That means we wrote out a check to restore the petty cash Imprest amount. Now let me explain this quickly. We have an account here. I'm just going to write PC, and petty cash is an asset. It has a debit balance of 1,500. Now this amount here is the Imprest amount, which means at the start of each month there will be 1,500 in the petty cash. Now what is petty cash? Petty cash is cash that we keep on the premises to make small payments. So at the start of each month there's an Imprest amount, a fixed amount of 1,500. Now what has happened here on the 28th? Money was spent from the petty cash in February, the month that we're looking at, and we need to get back to 1,500. In order to get back to 1,500, we need to know what was spent in February. Now if you were drawing up the petty cash journal at the same time, we would know, but we don't have that information. So now we need to go and find all the transactions on the 12th, on the 15th, on the 18th, on the 25th, on the 25th again, all the transactions that relate to petty cash. So to get back to the 1,500, we need to replace into petty cash the amounts of money that were spent. And if you go and add up all those transactions, 1,270 was spent in the month of February. So that money needs to be replaced in order to get it back to the Imprest amount, the opening balance amount. So we draw a check and we get cash for this check. So under name of payee you write cash. Where did this money come from? Our current bank account. And where is it going to go? It's going to go to the petty cash to restore the Imprest amount that we started with. So we need to replace the money that we spent out of petty cash, 1,270, and you calculate that amount by adding up all the transactions for the month of February that relate to petty cash, and that's how you calculate that amount in this transaction. I thought you might need just a little break from the accounting. So just imagine you're walking on the beach, and then this arrives. This is just a reminder of how that petty cash amount was calculated. I took all the transactions for February, we added them up, 300, 500, 245, that comes to 175, and 50 to pay for all those bouncing balls of Caleb, and that is how the amount was calculated. That is the amount that went into the Cashbook payments, 1270, to restore the Imprest amount. We need to replace what has been spent for the month. And the lesson is getting long. So let's speed it up. Let's see what transaction we're dealing with now. It says here on the 28th we paid the rates and taxes. The rates and taxes was broken down into the following. Assessment rates 205, electricity, refuse and water. Now I'm going to give you a heads up here. On the assessment rates, there is no VAT. We have to pay these rates and taxes for our business to operate. So we can claim VAT on 3 of the 4 items: electricity, refuse, and water. But assessment rates, there is no VAT. So this gets a little bit tricky when we need to calculate the input VAT. But I will show you how to do it. Once I've shown you, it's easy. So the amount that comes out of our bank account is the total of the 4 items: 205 plus 1,100 plus 41 plus 312, and that gives us 1658. We're paying by a check. It's most probably done by EFT, but we'll leave this as a check. Who was the check made out to? The municipality. Now the input VAT amount is the total 1658 less that 205, which is the assessment rate, multiplied by the VAT fraction. So we take off the assessment rates amount because there's 0 VAT on assessment rates. And that, ladies and gentlemen, or lady or gentleman, the amount of the input VAT is 189.52. And then the exclusive amount for rates and taxes is the total amount minus the input VAT less the input VAT is 1468 and 48. There we go. So a little tricky one. Assessment rates, there's no VAT. Remember to take it off when you calculate the input VAT. Next transaction. Let me clean this up a bit. It's a little bit of a mess here. I like to work with this highlighter. It feels like I'm a bit of an artist, although I am far from that. Next transaction. The bank statement also showed a debit order to pay F&B insurance for insurance 1325. Now insurance is exempt from VAT. So it's F&B insurance. That's who we paid. We got the information from the bank statement. The amount is 1325. And what did we pay for? Insurance. It appears under sundry because this transaction doesn't happen on a regular basis. So it appears under sundry. There we go. Nice, easy one. And the last transaction that goes into the Cashbook payments for the month of February is bank charges. Right, the bank is in business to make a profit. When we transact with the bank, we are charged. So they're bank charges, and let's have a look what they are. Bank charges amounted to 507. Where did we get that information? We pick up that information from the bank statement. The name of the bank whom we're going to pay is, remember, we bank with the bank. The amount that our account was debited with on the bank statement is 507. It's important to understand the books of the bank and our books because they're the opposite. I have a lesson on that. You can go check it out. Now, 7 rand or 7 of the government is a government levy, and the government levy, there is no VAT. So in order to calculate input VAT, because remember, bank charges, we need a bank in order to operate, so we can claim input VAT, but not on a government levy, which is included in this 507. So to calculate the VAT, we need to take off the government levy. So it's 507 minus 7 in brackets, because you must do that first. Remember BODMAS. That gives us 500 times by 15 over 115. And therefore the input VAT is 65.22. And 507 minus 65.22 is bank charges excluding VAT 441.78. Now what I'm going to do is I'm going to show you the complete Cashbook payments without all the workings, so you can get an idea of what it would look like if you're doing it manually. Then we're going to post to the general ledger. All the information is going to be taken to the general ledger accounts from the Cashbook payments. Remember, the journals take the load off the ledger. So we're going to post the totals of columns, etc. to the general ledger, and I'm going to explain, according to the accounting rules, why accounts are debited and credited. This is what our completed Cashbook payments for Calibre Education for February looks like. It has its own reference, Cashbook payments number 2. You got all your column headings, all the people that were paid, all the documents, the days the transactions took place. Every single transaction appears under bank. I see there's a typo here. There should be 5,000 under bank. It's been left out. And you have columns for input VAT. Nothing appeared here under debtors control, trading inventory, and all these sundry transactions that took place. There's just the bank account was credited, all these other accounts were debited. But I'm going to show you that in a moment, why the accounts were debited and credited. But this here is the completed Cashbook payments, and you guys are fantastic because you know how to do a Cashbook payments, and you're going to get 100% for it. In your syllabus you might not have VAT, and then it's quite easy. It's even easier. This column wouldn't be, the VAT column wouldn't be in the journal, and you do all the other columns but not calculate VAT if it's not in your syllabus or you don't use VAT in your country. Now let's start taking this information from the journal to the general ledger, the next step of the bookkeeping cycle. It's tough to work when you're surrounded by scenery like this, but let's carry on. I've included here, I just want to point something out, the trial balance of Calibre Education from January, the month before. Now remember, a trial balance is a summary of all the accounts, balances, and it's a checking mechanism, and you see if your debits equal your credits. But what I want to point out here is just this. These accounts, capital drawings, they all B accounts. That B stands for balance sheet, but the name of a balance sheet, the name has changed. It's statement of financial position. But these are the references for each account, the folios for each account, B1, B2, B3, B4, B5. So when I do the ledger accounts, you'll understand where these folios B1, B2, B3, where they've come from. When the accounts were set up, they were given these folios. And likewise with the nominal accounts, your income and expense accounts, they were also given folios. So when we do the ledger accounts, you will understand where all these folios come from. They come from, in this case here, the trial balance, or when the accounts were set up. They were given a reference, a folio. Oh, accounting, it's trending, accounting in the clouds. It's happening quite a lot. What we need to do now is we need to take the information from the journal to the accounts in the general ledger. Now a tip, if you're given the exercise to post the information from the journals to the ledger, is maybe do the sundry accounts first, because the sundry accounts, the information needs to be taken to the ledger on the day the transaction took place. If an item, say for example here, this creditor's control account, if an item has its own column, the information is taken, the total is taken on the last day of the month. But if an account appears under sundry, like loan, the bank, the information is taken on the day the transaction took place. The purpose of a journal is to take the load off the ledger. And how it takes the load off the ledger is, say for example, this bank column. The total of the payments is posted to the bank account, not the individual amounts. That was done in this journal. And the total of payments for the month of February is taken to the bank account. But I would like you to start in the sundry accounts section, because you're more likely to get the date order right in the general ledger accounts. So let's start with the loan. Now, this transaction here, Calibu Education paid an installment of $2,000 on the loan that they have with the bank. The information was recorded in the Cashbook payments, and now it is getting taken to the general ledger, the account in the general ledger. So the account in the general ledger, loan, the bank, from here, is account number B3. Remember I showed you the trial balance. Balance sheet account number 3. That is the folio reference for this account. Now, when you take the information to the general ledger from the journal, you need to post this information either on the debit side or the credit side. And the only way you can do that is if you know your rules and you understand your accounting. Go and check out that video of mine on the accounting rules. Now, loan is a liability because Calibu Education owes the bank money. Now, what has happened here is a payment, an installment was made, and the loan is going to decrease. And the rule says if the loan decreases, the loan account will be debited because the loan account is a liability. So on the debit side, you're going to have the year, the month, the day the transaction took place, because it appears under sundry in the Cashbook payments. Under details, the name of the contra account, the other account affected by the transaction, is bank. Where did we get the information from? The Cashbook payments number 2. So you fill that in under folio. And what was the amount? 2,000. Now I'm only looking at the transactions from the Cashbook payments, but there would have been a balance here on the credit side when the loan was taken out. But we're only looking at the transactions from the Cashbook payments. That's why I've only shown this installment here being paid back, because we're only looking at the Cashbook payments in this video. So there's the first posting from the journal to a ledger account. Remember I said work with the sundry accounts, so we're going to work around like this, the sundry accounts, and then we're going to get to work from left to right. We're going to take the information from the bank account, creditors control, input VAT, debtors control. That's how we're going to work. Then hopefully all the transactions will stay in date order in the general ledger accounts, especially when you're posting from all the journals at the same time. You need to get these ledger accounts, if you want to be completely accurate, like all good bookkeepers are, get it in date order. From heaven back down to earth. As we move on here, the next transaction we're going to post to the general ledger is this payment of fuel, which took place on the 18th. So let's go ahead, and we see we have the fuel account, and the fuel account is N12, nominal account number 12. The fuel account is an expense. The expense has increased, so the account needs to be debited. And we've got the year, the month, the day the transaction took place under details, the name of the contra account, where did the information come from, the Cashbook payments number 2, and what was the amount. Now you should be getting into the habit of applying your rules. An increase in expense because we paid for fuel, and fuel is an expense. The account needs to be debited. So now we have posted the loan and fuel to their respective ledger accounts. Keep up the good work. We are nearly there, and we can go on a holiday or a vacation, but we're still in the Cashbook payments. And what we're going to do here is we're going to post the information on the 18th, another transaction where we paid for the staff kettle and the wages. We need to take that to the general ledger. So in the general ledger we have the debit side and the credit side. Staff expenses is exactly what it says it is. It's an expense. And wages is an expense to Calibre Education, and the rule says if there's an increase in expense, the account needs to be debited. So on the debit side of staff expenses, we got 2024 February, the day the transaction took place. Under details we got bank, where did the information come from, the Cashbook payments, and how much was it, 345. And likewise with wages, except the transaction took place later in the month on the 25th. The amount here is 5,000, and where did the information come from? So you see what we're doing. We're taking the information from the journals and we're posting that information to the ledger accounts. And later on we're going to draw up a trial balance at the end of February to check the numbers at the end of February. So there we go, we've taken that information to staff expenses and wages. We debited both accounts. Why? Because it's an increase in expense. Important, the rules. And the next transaction that needs posting to the general ledger, we're looking at the equipment account that was purchased on the 23rd from the computer store. I remember it was a deposit that was paid for the smart screen, the smart TV, to be used in business operations. Now we look at the equipment account and we decide, should it be debited or should it be credited? And equipment is an asset, and they say, according to accounting rules, if the value of our equipment, which is an asset, increases, the account must be debited. If you know your rules, you will always work accurately. If you can classify each general ledger account according to whether it's an asset, income, expense, liability, capital, drawings, you can't go wrong. You need to know your rules. The date, the day the transaction took place, because this came from the Cashbook payments, the contra account to all the accounts in the Cashbook payments is bank. Under details you will have bank. Where was this information taken from? The Cashbook payments. And what was the amount? Remember, we are recording all these amounts here in these ledger accounts at VAT exclusive amounts, the VAT exclusive cost. The historical cost of the equipment was 1739 and 13 cents. The equipment account was debited because we applied the accounting rules. Keep it up. We're getting there. We're nearly finished with the Cashbook payments while posting to the general ledger from the Cashbook payments. Keep up the great work. And what happened on the 28th? There was a transaction which restored the Imprest petty cash amount. I explained that earlier. So this information needs to be taken to the petty cash account in the general ledger, which is a current asset. It's an asset. The value of our petty cash increased because we went and took money out of the bank account and we put it into the petty cash. So we put in the date, and by the way, because it increased, the rule says the account must be debited. The contra account to petty cash is bank. Where did we get this information? From the Cashbook payments. What was the amount? 1270. Remember earlier we had to calculate what this amount would be by adding up all those transactions which related to petty cash. So there's the posting from the Cashbook payments to the general ledger. And I'm starting to pick up a bit of speed here because you guys are getting the hang of this. You're getting the idea. We're taking the information from the journal to the ledger account. We're posting the information from the journal to the ledger account. Next, down the sundry column is rates and taxes. The amount was 1468 and 48. Rates and taxes is an expense. There's an increase in expense. The rule says the account must be debited. So we put the entry on the left hand side, which is the debit side. There's the date. The contra account is bank. Where did the information come from? The Cashbook payments. What is the amount? 1468 and 48. So now we've done rates and taxes. Insurance and bank charges. In the journal, in the sundry column, there we have insurance and bank charges. That information needs to go to the general ledger. What are these accounts? They're expense accounts according to the definition of an expense. Just to recap, those are their references. When we set up these accounts, insurance was nominal account number 8 and bank charges was nominal account number 9. They are both expenses. The expense has increased. So both accounts need to be debited with the amounts of the respective transactions. So there you go. Insurance was debited, bank charges was debited, and under details you have the name of the contra account, which was bank. When I talk about contra account, I'll explain that quickly. In this transaction, let's take for example insurance, because there's no VAT involved. If I look at that transaction in isolation, paid for insurance from our bank account, we got bank and insurance. What I'm drawing up here, I'm using T accounts to explain this. You can go check out my video on T accounts, what they mean, what it means. So bank is an asset. If you were an overdraft, it would be a liability. Insurance is an expense. Now in this transaction, insurance was debited and bank was credited. Insurance was debited because it's an increase in expense. There we go. Bank was credited. I'm going to say we had a positive balance because there was a decrease in assets. These two accounts are contra accounts to each other. The one account was debited and the other account was credited. The contra account is the other account involved in the transaction. It's a little bit more complicated when there's VAT in a transaction. But now you understand what is a contra account, if you didn't see that earlier video. Bank charges gets debited. Why? Increase in expense. We've worked on the sundry accounts section and we've posted all this information to the general ledger, and now what I'm going to do is I'm going to work from left to right across the columns. So the first column we have bank. Now our bank account I know has a positive bank balance, but remember we're only looking at the payments for the month of February and posting the payments to the general ledger for February. But I know we have a balance here which is positive. So our bank account is an asset. And what has happened when we have made payments, there we go, of 101,922.50 cents for the month of February, our bank balance has decreased, and the rule says we must credit our bank account, and it's on the last day of the month because bank has its own column. Under details, you cannot go and write every contra account which makes up this amount of 101,922.50. And what I mean by that is the amount that we paid to creditors control. There was input VAT. There was trading inventory bought. There were all these items under sundry. All those items make up total payments of 101,922.50. So under details we write total payments, and there we go. The bank account was credited, and why? Because the value of our bank balance decreased. Bank is an asset. a decrease in assets, the rule says credit the account. And as we're moving through the journal from left to right, our next column is creditors control, and there's the amount that was paid to the creditors for the month of February, 72,067.50. Remember, in this exercise we only got one creditor, the computer store, so that amount of money was paid to the computer store. And a creditor, remember we're in the general ledger, so we're looking at the control account, accounts payable, creditors control, which is a summary of all the individual creditors, but we only have one in this exercise. Now, when we owe money, a creditor is a liability, and what has happened here is our liabilities when we pay our creditors have actually decreased, and a decrease in liabilities according to the rule says debit the account. And the same as per norm, the date, the last day of the month. Remember, February 2024 is a leap year, so there are 29 days in the year. Under details, bank, where did we get the information from? The Cashbook payments, and what was the amount? We got it from the total of the column, and we posted to the creditors control account, which is B12, the 12th account in the balance sheet section, which is actually the statement of financial position section, but the folios we're leaving with a B, B12. So creditors control was debited. We applied our rules. A decrease in liabilities, the rule says debit the account. We're nearly there. We are on the input VAT account, and we need to take the total to the general ledger account, and we go and categorize input VAT. We are nearly there. Input VAT is an asset to Calibu Education. We can claim this money back from the revenue services. So it is an increase in assets. We must debit the account. The value of input VAT has increased, and that amount there we take from the total in the Cashbook payments of the input VAT account, and under details the name of the contra account, and because it has its own column, we take the information on the last day of the month, 2024, February the 29th. So input VAT was debited. And exciting news, the last posting we need to do is the total from the trading inventory account. Remember, trading inventory is an asset. When we buy stock, the value of the asset has increased. An increase in assets, the rule says we must debit the account. So the entry goes in on the left hand side of the trading inventory account, which is B account 6, balance sheet account number 6. Last day of the month, because it had its own column. Contra account is bank. Where did we get the information from? The Cashbook payments number 2. And what was the amount? The total of the trading inventory column. And that, we've posted all these amounts to these accounts in the general ledger. We've done the bank column. We've done the creditors control column. Input VAT. There was nothing to do with debtors control here. We posted the trading inventory amount to the general ledger. So we have finished posting all these transactions from the journals to the general ledger, only with regard in this lesson to Cashbook payments. Well done everyone, well done on getting to this stage of the video. And it has started to rain, and to summarize what we've just done, we've looked at the Cashbook payments. We looked at all the transactions with regard to cash purchases. We looked at the documents that recorded the cash purchases. For example, a check and a check counterfoil. We looked at the supporting documentation. So we looked at the documents. From there, we took the information. In this lesson, we did the Cashbook payments. In the previous lesson, we did the Cashbook receipts. And from the Cashbook payments, we took the information, and the terminology we use is we posted the information to the general ledger accounts. So all the transactions ended up in the general ledger. Later on, we're going to draw up a trial balance, and we're going to see the numbers at the end of the month and at the end of the year. So you're doing well. Just keep it up. I'm not feeling as green as what I was. And if you think you're losing your marbles, don't worry. You're not the only one. Thanks for watching, and we'll see you in my next journal, the Petty Cash Journal. Take care.